let's talk about one of the most misunderstood words in real estate, the capitalization rate, or as the internet likes to call it, cap rate. Usually it's followed by completely wrong explanation from someone who just bought their first duplex last week and now they think they're Warren Buffett. Cap rate is not mystical, it is not complicated, and it's definitely not some IQ test that everybody pretends it to be. It is simply a return metric, a way to measure how much income a property produces relative to its value. If you bought it in all cash, that's the part that everybody forgets. Cap rate ignores your mortgages. It pretends that you're rich and can pay for property all cash. It pretends that you wired the whole purchase price without even blinking an eye. So think of it like this. If you pay $1 million for a building and that building generates $50,000 of net operating income, not gross rent, not pre-expense fantasy money, but true operating income, then your cap rate is 5%. That is it. There's no magic, no music, no angels descending from the ceiling, just income divided by price. And here's why it matters. Cap rate tells you how market values income, not how you personally value it, not how your lender values it, but how the entire market values it at this very moment in time. Cap rates are basically a city's risk meter, big neon sign that says this is how much return you expect for buying a property in this zip code. A high cap rate, 8, 9, 10% usually means the area is riskier. Maybe rents are unstable, maybe crime is up, maybe the job market isn't growing, or maybe supply is too high and demand is low. So high cap rate equals higher returns, but also higher headache. And a low cap rate, on the other hand, 3, 4, 5%, usually means the market is stable, it's very desirable, and sometimes painfully competitive. These are the places that institutions just swarm like bees, but they'd rather earn a lower return in a stable market than try to chase a unicorn returns in chaos. That's the first secret beginners miss. Cap rate isn't really about the property, it's about the market that surrounds that property. Now, when you're analyzing a rental property, the first thing you should do before you even get excited about stainless steel appliances or whatever HDTV planted in your brain is calculate the actual NOI. So you take your gross rents, you subtract taxes, insurance, utilities that you're responsible for, subtract property management, maintenance, vacancy allowance, repairs, capital expenditures, all the little gremlins that are eating your money whether you acknowledge them or not. And what's left is the NOI. That number is your anchor. Everything else is just noise. Now you're going to divide that NOI by the purchase price or the price that you think that the property should list for if you're still trying to just land an offer. And that percentage is your cap rate. A beginner will see a low cap rate and immediately panic. 4%, that's terrible. No. That might be fantastic if you're in a market where the average is 3.5. Or a beginner will see a high cap rate and start celebrating. 9% passive income? Also no, because that might be the market's way of saying run. Context in this situation is absolutely everything. If your market averages 6% and you find a deal at 7, that's interesting. But if your market averages 6 and the deal is at 4, that's a problem. Unless there is a value add plan that can push the rents up and reduce expenses dramatically. This is where cap rate becomes not just a snapshot, but a real test. You're asking yourself, does this building perform above, below, or in line with what the market expects? And here's the part where you graduate from beginner to an actual operator. Cap rate is not about what you get today. It's about what you can force tomorrow. Maybe you raise rents. Maybe you reduce expenses. Maybe you add, let's say, laundry income, or parking income, pet fees, storage rooms, better management. All of the above will increase NOI. And if the market cap rate stays the same, any increase in NOI instantly increases the value of the building. That's the real game. That's why wealthy investors, they don't obsess over cash flow. They obsess over NOI and cap rate, because those two numbers determine the wealth swing. And let me give you the cleanest example possible. If you buy a property that produces exactly $100,000 of NOI in a 5% cap rate market, that building is worth $2 million. If you add just $20,000 of NOI a year through maybe better management, smarter operations, or just bringing rents up to market, that new NOI divided by 5% cap rate adds $400,000 in value. You didn't build anything, you didn't flip anything, you didn't open a second business. You just managed the asset more intelligently and better than the previous owner. And that's the power of cap rate. It's the pricing mechanism. It's how the market rewards or punishes operational skill. And once you understand that, analyzing rental properties becomes way less emotional, less intimidating, and a lot more like playing a game you can actually win. Calculate NOI, divide by price, compare to the market cap rate. Identify value add opportunities, decide whether the potential NOI boost justifies the price. Everything beyond that, the decor, the paint colors, granite countertops, it's all decoration. And cap rate is the engine. That's how you analyze rental properties like someone who owns them, not just likes them. This is Thrive Network. Comment, like, subscribe, and we hope to see you on the next one.